Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Arundhati Ramanan. These are the top headlines from the startup space. Avance Financial Services raises 1,200 crore rupees from existing shareholders, work with Pincus Kedaria Capital and Alpha Investment. This fresh capital raised will be utilized to scale education loan disbursements, improve education infrastructure and deepen institutional partnerships, it said.
Myler Play bags $1 million as part of an ongoing funding round ahead of a Series A round. Rounds saw continued backing from CDM Capital and Credit Sison, along with new participation from Growth Cap Ventures. The proceeds will be used to strengthen core payment infrastructure, expand its product stack, and deepen integrations.
Dream Sports FanCode announces an exclusive multi-year partnership with ATP Media to expand its sports offering with the addition of tennis as part of the agreement. FanCode will hold exclusive broadcast and streaming rights to ATP Tour's marquee tennis events in the Indian subcontinent until 2028.
Amidst a raging debate on gig workers, a stress test of the quick commerce business model points to a fragile ecosystem. Gig workers can be paid more provided certain scenarios play out and the average order value sees a sharp rise. Those were the headlines that we're tracking for you this evening. But on the hot seat today, MAGMA Group is scaling fast in India's circular economy and sustainable material space. The company has just consolidated its Series A round at $8 million, with existing investors, including Bill Gates-backed Capria Ventures, doubling down alongside fresh capital from Gujarat's state-backed venture fund. Profitable since inception, MAGMA posted revenues of over 215 crore rupees last year, with a 500 crore rupee order book and operations now spanning 12 states. Joining us now is Neil Tucker to break down the growth story, the fundraise, and what's next on MAGMA's expansion roadmap. Neil, thank you so much for taking time out and being here with us on Startup Street. You know, as I just pointed out, you've closed this $8 million Series A round with existing backers like Bill Gates-backed Capria Ventures doubling down, right? What gave investors the confidence to increase their bets at this stage of MAGMA's journey? Take us through what MAGMA is solving for and, you know, the kind of offerings you have.
Thanks, Arundhati, first of all, for having me. You know, it's great to be back on the show again. You know, a lot has progressed for us since when we announced the first close of our Series A, Arundhati. So, you know, it's been a meaningful journey for us. We have solidified our advanced materials business with the launch of our private label arm, Teramag, which now has a growing portfolio across glazing chemicals, coating chemicals, metallurgical inputs, polymer compounds. So we've grown a lot in the raw material space. When I talk about the green businesses, you know, we now have an active footprint across 12 states in India, spanning paper, plastics, biomaterials, some of which even getting critical market share in certain geographies. So the green businesses have acted as a good cash cow for the company. When we look at you know, the overall contours of the round, you know, we're so excited and lucky to be having our existing shareholders double down with this additional pool of capital. And predominantly, you know, the company has you know, operationally grown by over 40% in revenue since the beginning of this fiscal year. When we look at our gross margins, you know, they've grown by over 35% since the beginning of this fiscal year. So I think in just a short span of 2 quarters, we've not only launched businesses, but we've also grown existing ones. We've grown the numbers, and you know, with the right sort of partners at Capria Ventures, Avinya Ventures, GVFL Limited, we continue to be excited to double down on the journey with them.
Sure, and you know, how will this $8 million Series A be deployed across capacity expansion, technology, and new verticals? And what do you believe will be MAGMA's strongest moat as competition sort of heats up in this space?
Yeah, no, that's a great question. You know, every call that we are making is backed by a 10 to 15 year vision, right? Advanced materials, green manufacturing, industrial recycling. We believe that these are actually the answer to India's precision manufacturing story today. And when we look at investing this new pool of capital that we've raised, we're looking at engineering and MRO as the next sector. Today, you know, MAGMA is serving over 300 factories, and we believe that our engineering and MRO vertical will allow us to cater to the precision stack for factories. So that's going to be a vertical expansion that we're looking at. We also want to double down on investing tech and the infra around it. Earlier this year, we launched Orbit, which is our order management system, which tracks every transaction We also want to add transaction level mapping. We want to add financial mapping. We want to add geography tracking. So our fundamental vision is that every truck that goes dispatches through Magma is tech enabled and giving our customers an ability to monitor high value cargo. Even on the geographic expansion, right, Arundhati, as we speak, we have a truck getting loaded in Daman and Diu, a truck getting loaded in Odisha, trucks going around in Gujarat. So the ability to build uh, right close to the factory floor, target industrial clusters, serve their critical needs is also where we're going to be spending a lot of capital and research and development around it. And lastly, with a diversified suite of offerings and looking at the competitive landscape, where we found our space is the precision backend stack. And that's where we also want to invest in growing the right team, having senior folks, making sure that we're able to achieve majority of our order book with the right kind of talent pool, helping us as we build from Ahmedabad.
All right. And Magma's revenue has grown 75% year on year to 215 crore rupees. And you've been profitable since inception in 2022, right? So what's driving the strong demand across such diverse verticals, and which segments are sort of contributing the most today, and where do you hope to end next year?
Yeah,
this year.
Yeah, absolutely. So, Arundhati, we sit at a 500 crore order book. We are confident that we will achieve at least 75% of that, invoice at least 75% of that within this fiscal year. So, about a ballpark figure can be ascertained from that percentage. When we look at, our story, I think where we see Magma's moat is being supplier first. We've very creatively designed our supply stack to be mix of asset light yet capex heavy, where process led control is required. So when we look at like advanced materials, Magma Green, these constitute to be our core verticals, which contribute about more than 70% of our revenue. And driving margin expansion, right? Because when you're serving the precision requirements, when you're serving and replacing their virgin requirements, it's going to translate into some sort of process-led IP and integration that we've been able to build, and we believe that's going to be an important driver for Magma's growth story. But coming back to the supplier first point, right, Arundhati, we believe that the company has structured three models. A company-owned, company-operated model, which is essentially the facilities we run on the back end, a company-owned, dealer-operated model, which is where we do some capex upgradation and leverage our existing supplier, and thirdly, a dealer-owned, dealer-operated model, which is essentially our leased out and conversion cost-linked supply units. But fundamentally, it ties into one thesis: is that we want to lock in one side of the marketplace. The benefit we get as a business is because of the underlying marketplace model. There are pools of demand and supply that we're able to very clearly see in front of us. And if you have one side of the marketplace already locked in, is something that you're already managing, it can give you a clear signal on which areas to spend time on, and where to double down and press the right levers towards revenue and bottom line expansion.
Sure, and you're targeting this ARR of 1,000 crore rupees over the next 18 months, right? So what needs to sort of go right operationally and commercially for you to hit that milestone?
Yeah, I think four things. One is, in a business like ours, capital rotation is a very important element. So when we conducted our financial due diligence by Deloitte last year, they noted a 18-day working capital cycle. It's now at close to about 30 days, which is still really great compared to the incumbents in the space. But I think capital rotation is where personally I, as a founder, I'm spending a lot of time on making sure that we have the right customers, we have the right capital rotation, we have the right debt partners, we have the right sort of vendors where we're getting extended credit terms. I think second is, when you're transitioning from a startup to an enterprise grade solution offering, you will also need to serve enterprise customers and enter into long-term contracts. And to be able to do that, you need a very consistent supply stack. And I think Magma is now entering that mature phase where we're able to take that on and pass it down to both our vendors as well as our downstream logistics partners. So I think that's going to be the second point. And third is, we, in a business like ours, we emphasize a lot on corporate governance, transparency, the goal of Magma is to be a very disciplined public market company in the future, right? And for that, we're laying down the right foundation by quarterly audits, making sure that every geography we're entering, there's the right sort of SOPs we're
Sure.
operating. So yeah.
All right, Neil, we're completely out of time, but thank you so much for joining us on the show today, and we wish you all the best on this journey going forward.
Thank you. Such a pleasure.
All right, moving on. Fitness may dominate New Year resolutions every year, but 2026 is shaping up to be different. Over the past year, fitness in India has quietly moved from being seasonal and aspirational to becoming consistent, flexible, and deeply integrated into everyday life. Consumers are blending gyms, digital workouts, wellness, and nutrition, demanding access over ownership. To decode what this shift means for India's fitness economy, I'm joined by Akshay Verma, the co-founder of FITPASS, a super membership for fitness and wellness with a 78% retention rate and a growing footprint across Tier 2 and Tier 3 India. Akshay, welcome back to Startup Street. As 2026 kicks off, fitness once again tops New Year resolutions. But are we seeing intent convert into long-term behavior and not just January enthusiasm?
Yeah, hi, thank you very much for having me. Yes, obviously when January comes, fitness becomes top of mind for everybody. But as we are seeing over the last 3 years, especially after COVID, there is a defined mindset shift where people are not seeing fitness as a hack or as a means to an end. And it has slowly become a priority for many people, and especially now that we are the world's youngest workforce, a young population. I think strength and flexibility have become top of mind, and 35% people, I believe a recent study said 35% people are now valuing fitness as a daily habit. So I think where we are moving is that it's no longer India's fitness economy, but it is becoming India's habit economy, which is what now FitPass is building. And we've just launched, I think we'll be the first company in the world where we have just launched a campaign where we reward you for building healthy habits. So every time you work out or you speak to a nutritionist and get a diet plan and log those meals, you earn hard cash. So while traditionally people thought that fitness memberships was something where you donated money and you did not show up for the rest of the year, but you bought a membership. So people made money by you not showing up. We're the first company in the world that is rewarding you with hard cash every time you show up, because fitness at the end of it is about showing up and about consistency.
Absolutely, Akshay. And, fitness today looks completely format agnostic, gyms, home workouts, digital classes, wellness, nutrition. Flexibility now matters more than brand loyalty or fixed memberships. So, Akshay, does this disrupt the traditional gym-centric model, and how critical is an ecosystem approach in driving consistency?
I think it is highly critical. It is so we don't have to think of gyms or any of these assets as where people are loyal to. People are actually loyal to experiences. It is the same thing whether it is with Airbnb or Uber or assets are not what people become loyal to. What experience they get there, how consistent their experience is what drives their loyalty and their consistency to keep coming back. So one is that I don't think people are loyal to gyms. People are loyal to experiences. Second, ecosystem approach is the only approach, because everybody knows that physical fitness has to go hand in hand with nutrition, and both of them have to go hand in hand with all healthy habits that build the ecosystem. And you need to track it, you need to measure it. There'll be days of less motivation. You have to build these healthy habits. And that's where our campaign of Thoda Fit Bano, Thoda Rich Bano comes in, where we're rewarding you exactly for building these healthy habits with hard cash. So ecosystem is the only way to go, where everything that a customer needs to be fit, get well, stay happy is in one place, and all of that data is done.
Sure. And, participation from Tier 2 and Tier 3 cities is rising sharply, Akshay. Is this growth being driven by consumer demand, or has access and pricing finally caught up with intent? Also with AI-led coaching and nutrition at FitPass across, 573 cities, how does tech actually build consistency and not just convenience?
This is a great question. So, no, I don't think pricing and access have been responsible for this. I think there is so much consumer demand that is still unmet that we are just following where the demand is. I don't think it was not that our pricing unlocked the demand. I think the demand existed, and our solution is the only one that can serve people at such a scale. So 573 cities, millions of users is a reflection of where aspiration is. Aspiration truly lies in Bharat. Even if you look at the gym infrastructure, only 30% of India's gym infrastructure is in the top few cities, the 10, 12 cities that we count. all of the 70% is actually in tier 2, tier 3. So the demand already existed. How does tech help personalize and build consistency? I think there is no other way. You need people to measure, track, get nudged, reminders. There are a lot of small things and big things that tech helps in, where people are able to stay consistent. Because like I said before, fitness is not a means to an end. It's not a hack. Right? It's a habit.
Yeah.
And habits are built slowly over time.
Okay.
And that is where consistency starts rewarding. It's not about intensity. So all of that only tech can help you to understand each personal journey and then get you there and then let you stay there.
Okay.
Through your ebbs and flows.
All right. You know, FitPass, Akshay, reports a 78% retention rate in a category known for drop-offs. What are you getting right in turning short-term motivation into long-term habit? Also, your corporate wellness platform now reaches over 17 lakh employees. Are workplaces emerging as the most underrated growth engine for fitness in India?
Well, these are very good questions. What we're getting right is, I think, we're the only people who made consumer the king. Right, from an infrastructure point of view, where gyms or the supply side was very restrictive in their pricing model, in their access model, all of that. So consumers did not feel like they had the flexibility, choice, or convenience. Suddenly, all of that power shifted to them. Now they go work out where they want, when they want, at home, at a center. They eat right. They follow up. So consumer became king. So all the friction points were broken. I think that is why people love us, and that is the 78% retention that we see, which is exactly the opposite of what the gyms actually see. Gyms see about 25% retention, means 75% of their customers drop off. We see the opposite because we made them the king. Are corporates the true growth engine? Yes and no. I think corporates that have understood that employees are assets and are forward thinkers have definitely started adopting this program at a high scale. When you say 17 lakh employees we serve, those are active. We actually serve crores of employees, out of which 17 lakh are active. So the potential of getting more people active is quite high. And now corporates who have global presence, who have global offices in the US and Europe, they have understood that fitness is not a productivity hack. It is actually something that helps them reduce costs, increase efficiency, retain talent. It's a cultural value. So those who understood are a growth driver, but there are a lot of promoter-driven Indian companies that have not yet gotten there. But yes, the trajectory is right. So is it a growth engine? 100%.
Okay. Yeah. One final question before I let you go. You're clocking, what, 173.9 crore rupees in ARR, 205% organic growth, and you claim a 54% market share. Akshay, with this kind of scale and traction, should we expect FitPass to play a leading role in consolidation, in consolidating India's fitness ecosystem through partnerships or acquisitions?
100%. I think you will hear about a lot of that. So those numbers are from last year. So these numbers, when we release them this year, will surprise you even more.
Okay.
And yes, consolidation is something that is already in the works, and that is the only way, because it is a very disaggregated ecosystem. So somebody has to bring it together, and we'll be honored to play that role and build the country's first integrated ecosystem for fitness and wellness.
Okay. All right, and we'll surely keep a track of that here on Startup Street. Akshay, many thanks for joining us today.
Thank you very much.
On that note, it is time for us to head into a short break. But coming up next, amidst a raging debate on gig workers, a stress test of the quick commerce business model points to fragile ecosystem. A CNBC TV18 analysis on the other side. Stay tuned.
Welcome back to Startup Street. Demands for higher payouts by gig workers has been met with pushback from quick commerce companies. This has opened up a national debate on the business model and the perceived exploitation of these workers. It's a debate as old as time, are profits being put above people? CNBC TV18's Mangalam Malu dissects the prevailing business model to understand how it works. Take a look.
At a 600 rupee average order value, the platform actually makes a revenue of 120 rupees. Fulfillment cost is 132 rupees, and they make a contribution loss of 12 rupees or a negative contribution margin of 2%. That explains why the average order value is everything in this business. At around 700 rupees, as you can see, the model finally breaks even around between 700 to 750, as you can see, and thereafter, there is contribution margin positive that comes in for these companies. Now let's talk about the quick gig worker. A quick commerce delivery partner typically earns about 40 to 50 rupees per order on quick commerce, and food delivery, which pays a little more than quick commerce per order, covers longer distances. So to that, what really matters is the earnings per hour, which could be between 70 to 20 after you account for about 20% in terms of fuel and other expenses. So for average work of around 9 to 10 hours per month and 25 to 26 days per month, we have an average monthly income of gig workers between 16,000 to about 31,000 rupees per month, which is actually slightly higher for a flexible work with earnings that are better than available alternatives. So what makes or breaks this model? The biggest revenue drivers, as we spoke, are average order value or the gross margin or take rate that these companies make. On the other hand, the biggest draggers are the rider payouts and dark store inefficiencies. Free deliveries and aggressive discounting also matter because they directly hit contribution margins. And in a competitive scenario, that's something that we will be monitoring. And here's the actual pressure point, which is the rider payouts. The business model is extremely sensitive to that. As you can see, at current costs, at 600 rupees, most of them are making contribution losses. But as you move ahead, 700 rupees of average order value, it is breaking even. But if 50 rupees moves into 60 rupees. If you look at the next plate, you would see that the average order value for you to be contribution positive or break even moves from 700 rupees to 800 rupees. And that's not all. Another hike of 10 rupees from 60 to 70 pushes it by about 1,000 rupees. So that is where the debate matters, because gig workers are not just a cost line, their earnings per hour determine efficiency, engagement, and long-term sustainability. The next time you place a quick commerce order, think about your basket size, the cost of fulfillment, and maybe ask your delivery partner how their day is going. That, in many ways, is the real anatomy of quick commerce.
All right, Mangalam, many thanks for those details. Now, after groceries, essentials and services, quick commerce has found its newest testing ground, fashion. From 30-minute party wear to same-day office outfits, speed is now reshaping how Indians shop for clothes. Shilpa Ranipeta looks at how startups and incumbents are racing to deliver fashion faster and whether this new model can actually make any money.
Fashion startups like Xylo, Knot and Zulu Club and D2C brands like New Me and Snitch are disrupting the familiar rhythm of clothes and shoe shopping in India. It's no longer about heading to the mall or store, trying on clothes and picking the ones you like. Nor is it about waiting a day or two to get delivery of online orders. The Indian consumer, well and truly hooked to quick commerce, wants that speed in fashion as well. It's not about urgency anymore.
So what behavior we have seen is a shift in how customer shops fashion. They're not doing planned shopping. They are doing fashion shopping instantly. They don't need to plan. They can buy fashion instantly. And this is the convenience and experience which is actually helping this customer to basically shift to this new way of shopping.
It's instant gratification, but that's the need of the hour.
Not just new players, Myntra was one of the first movers in the space with MNow. Reliance Retail's AJIO Rush has also seen takers. Strong demand has these firms ramping up this offering.
We now have nearly 80 plus dark stores that exist across most of the metro cities in India, but we are also kind of going to the next set of cities very soon. And across this set of dark stores, we have nearly 20% of our customer bases in these cities and in these clusters have now started shopping on MNow.
There are two basic business models. One, a marketplace-led approach built around dark stores. Two, a brand-led approach using existing stores for quick fulfillment. Increasingly, even multi-brand e-marketplaces are exploring fulfillment through brand partner stores.
We did not rely on dark stores. We already have a dense enough network of stores in, uh, tier one cities. For example, in Bangalore, we already have about 15, 17 stores. We are using some of those back room inventory to be able to fulfill these orders. We are trying to run our stores almost, or the back room of our stores like a warehouse to be able to, our pick pack times are within 3 minutes today.
Adding speed to a segment that has been all about trials, sizing, and returns makes it trickier. Some players are betting on tech to navigate this. Some are letting customers try outfits on at home before finalizing the sale.
Look at the e-commerce platforms and the economics at which they are operating. It is far more economical to work at a try-at-home, bunched orders, all of those items across multiple brands coming in a single order. The delivery person waiting there for 30 minutes, even up to 30 minutes, and taking the returned bag. That unit economics is almost far more exciting for sustainably growing this business than just a distributed e-commerce delivery model.
Not everyone agrees.
I strongly believe try and buy is a waste of time. I don't think customers except certain cities are going to do try and buy. It's a very strong security risk where the delivery guy is standing outside your home. Try and buy itself, I feel it doesn't make any economic sense.
Investors say both approaches can work, but only at the right economics. Unlike grocery and essentials, fashion quick commerce will only work at much higher average order values, say an order of 2,000 rupees or higher.
It's early days yet, and jury's still out on which model actually works better. But one thing is clear, speed is fast becoming a permanent layer in fashion retail. So only platforms that can crack scale, dense demand, and seamless last-mile execution may survive. In Mumbai, Shilpa Rani Peta.
Well, with that, it's a wrap from Arundhati and me, Shruti, on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Good evening. Thanks very much for joining us on India Business Hour. I'm Shireen Bhan. The top stories we're tracking for you this evening. 48 hours after being captured by U.S. forces, deposed Venezuelan President Nicolas Maduro and his wife appear before a New York court to face charges of narco-terrorism. Venezuela's interim president softened stance, offers to collaborate with the U.S. after President Trump threatens more strikes. Russia, China and major Latin American nations slam Maduro's capture as a violation of international law. The UN General Secretary is deeply alarmed, calls the US strikes a dangerous precedent. European leaders call for restraint by all actors. India expresses deep concern and calls for peace in a carefully worded statement. A majority of market participants expect a 10 to 20% Nifty returns in 2026 as per a CNBC TV18 market poll. Financials emerge as the top sector, followed by metals. That's an exclusive. Top economists are divided on the growth trajectory. 50% of economists polled by CNBC TV18 expect the GDP growth to cross 7% in the coming fiscal. Majority expect inflation to inch above 4% and the rupee to hit 92 against the dollar by FY27.
Modi's a very good man.
Yes.
He's a good guy. He knew I was not happy, and it was important to make me happy. They do trade. And we can raise tariffs on them very quickly.
President Trump warns tariffs imposed on India can rise very quickly if New Delhi does not cooperate with Washington on Russian oil. Trump also says India has reduced oil imports from Russia to make him happy. Amidst a raging debate on gig workers, a stress test of the quick commerce business model points to a fragile ecosystem. Gig workers can be paid more provided certain scenarios play out and the average order value sees a sharp rise. The Supreme Court denies bail to Omar Khalid and Sharjeel Imam in the 2020 Delhi riots conspiracy case. Both have spent over 5 years in jail without trial. The court says the period of incarceration is substantial, but it has not crossed constitutional limits. 5 others accused get conditional bail. The souring diplomatic ties between India and Bangladesh spills onto the cricket field. Bangladesh refuses to play the T20 World Cup in India and bans the broadcast of the Indian Premier League. This after the Kolkata Knight Riders released Bangladeshi cricketer Mustafizur Rahman after a nudge from the BCCI. Well, as always, let's start with the day's market action. The market's failing to hold on to the levels around record highs that they touched, with the Nifty ending below the 26,300 mark. The Nifty Bank, in fact, closed in the red, with HDFC Bank down over 2%. IT stocks were under pressure, while defense and FMCG stocks ended the day in the green. A flat close for our markets today, but all the sectoral indices and the Sensex